Hi guys, so while it is a hot topic of discussion, let's break down the US dollar and of course the FOMC, who have been very much in the forefront of the market participants' thinking with their trading. So as we know, the Federal Reserve at their previous rate decision, they did make it clear that they're going to start winding it in or slowing down in terms of their rate hiking cycle, and that has had an adverse effect on the US dollar. The greenback has been underperforming of late, and that's not just obviously due to the mess going on at the moment with the government shutdown. This is really being driven by monetary policy, and that being priced into the markets that the Fed are going to start slowing down. And that really confirmed at the minutes last night on Wednesday evening, where they said the Fed are going to be a bit more patient with future rate rises. And you know, the dollar really started to gather some pace to the downside in terms of its weakness with Jerome Powell, the Fed chair, who was speaking last Friday and just making it clear that the Fed could adjust their balance sheet if need be. So the fact that policy could now go either way, you know, they could start pumping more money back into the markets, essentially a dovish move. Obviously, of course, that's dollar weakness. And then yesterday we had a couple of Fed speakers, Fed's Bostic and also Fed's Rosengren, who echoed the same sort of tone. And Fed's Bostic initially said that rates could go either up or down. So, you know, that is quite dovish there. The fact they could even move rates to the downside. So, yeah, it's quite dovish of late, and hence that's why we're really starting to see, or we have been seeing some dollar weakness as market participants start to price in the fact that of a Federal Reserve slowdown with their rate hiking cycle. And just for anyone that doesn't know, you know, if you see this from a consumer perspective, if of course rates are being raised, this is naturally taking more money out of consumer pockets that they might not have. You know, you have less disposable income to go shopping or spend your money on this, that and the other. You know, and also, you know, you're going to be paying more money on your any outstanding loans, more money on credit card balances that you have. And then from a business perspective, if you've got business loans and you're a business, then you're going to be paying more interest on that because interest rates are rising, which means they're going to have to recoup those additional costs that they're incurring. So what do? They raise the cost of either their product or their service, and then that gets passed on to the consumer. So the consumer, again, is left more out of the pocket. So with these rate rises, naturally, when a central bank is raising rates, you are going to be hampering and slowing down growth. That is the intention of that, to slow down growth. So there were worries that the Federal Reserve were moving too quickly of that, hence why we're seeing some pressure to the downside quite drastically with the stock markets across the board. So yeah, in terms of the Federal Reserve tone at the moment, it is looking dovish as they sit more on the fence now and observing the big economic picture as things look a little bit shaky, not even just the US, but globally.